Good day, fellow investors. In a video where we discuss Sirius and my performance, there was a flood of comments discussing how it might be just better to invest in index funds rather than bothering with stocks. So the key topic I want to discuss today is, does it pay to beat the market? And I can tell you immediately, I firmly believe that investing, value investing, looking at what you are investing, thinking about investing, does destroy the market over the long term, does so much better than the average, which is the market for you in your life. And that's why I will keep sharing my truth, my conviction that value investing, thinking about investing, does so much better for a person. And I can go so far that I firmly believe that from now on, 2024, in the next 10, 20 years, we will obliterate the market because of the risk and reward in the current position, and because it is simply how it works. And that's what I want to discuss in this video by answering the questions and the statements that were made in all those comments. So let's immediately start with this comment from Miscellaneous. Just put your money in some index fund and you will be fine long term. Don't try to beat the market, because we as retail investors will most probably lose money. And now we'll go through all the other comments because this is so important. So let's immediately start with this one: trying to beat the market versus investing for compounding wealth. So we will probably lose money trying to beat the market, and I agree 100% with that. The thing is, I'm not trying to beat the market. I'm trying to find the best investments, the best businesses that will compound my wealth over time. I don't give a rat's ass about the market, to use Charlie Munger's terms. So the market did 29% in the last year. That's something staggering, amazing, great, good for all of those holding. I hope you know what you're doing, but that's not investing for me. This is investing. The S&P 500 dividend yield is now at 1.33%, close to all-time historical lows for dividend yields of an index fund. Historical average around 5.5%, last 30 years much lower, but to me the business is the driver of my returns. So if I'm paying 70 times the dividend yield, I know that my long-term returns will be very, very low. Plus, what happened when those dividend yields were low? 1970s, 2000s, 1929. Well, let me show you this chart. Crash, I think it was 86%, 75% adjusted for inflation. This was also a huge crash, 60-70% adjusted for inflation. And that is because sooner or later things revert. This was a great run, this was a great run, and this was a great run. But what comes after those great runs is a decade or even more, 3 decades of ugly, ugly, ugly. Because I believe that the dividend yield, the cash flows, is what drives your long-term investment returns, your long-term wealth accumulation. So I'm not trying to beat the market. It's very, very hard to beat the market in the last 10 years because the Fed just prints money and interest rates went from 6% to 0, so all financial assets go up, and now interest rates are higher, but the market still expects that those will be lower because Powell farted it 2 years ago, and nobody wants to see, okay, maybe the situation will change. So that's how it goes. But if I look at my investing journey, I was always focused at good businesses at the right price, at a fair price where there is some return, and then I just let those compound for a good return over time. More about my story in the investment psychology video we discussed yesterday. So rewards to me is what always works. This isn't a great reward, therefore I can bet that the Fed will do whatever, but if that changes, and in history there are these long-term periods when that changes, then this stocks only go up suddenly doesn't work. And actually I would argue that we are in a 40-year, 44-year bull market, 42-year bull market on lower rates and money printing, and the next 40 years when things shift might be very, very ugly. And that's what I'm saying. It might be very, very ugly. Amazing how well the S&P 500 works. Yes, the S&P 500 worked great over the last 40 years in this bull market. But that is because interest rates went from 20 to 0, and now people are expecting those will be again low. If we have this that happened in history and might happen again, then stock market returns will be terribly ugly. Because as interest rates went down, the P ratio went from 6.79 in the 1980s to the current 27. That's just valuation expansion because people are happy to pay a higher price compared to low expected interest rates. But the S&P 500 is now 5,308 points, and this is the key. If we go to the normal historical P ratio, let's say 13.5, the S&P 500 goes down. P is 7, 1,371 points. And then you say, Sven, you're crazy. Look at this. It happens. It happens. It will happen twice in your lifetime. And if it happens in the next 10 years, then this comment might not hold water forever. And that's the key. I want to invest that whatever happens, my portfolios hold water, and if the P ratio reverts, you can expect a 45 or a 74% decline in the stock market. And then you can see here, it happened, it happened, it happened, it happened. We will see in the future. But I'm not taking that risk. That's value investing. So, The Exorcist, the question is if it's really worth to put so much energy and time into single stocks and not just simply put the money into an index fund and use the energy and time to find additional cash flow investments. Well, if I look at my story here, this changed my life, this changed my life, this here, buying houses when everyone was telling me don't buy a house, changed my life. This really changed my life, gave me opportunities, and I think it will change also in the future. The thing is that I'm a little bit allergic to average. Index funds, markets, okay, average, and that is great for average people, average aspirations, average money management, even better than index funds, but I want more. And that I want more delivered much more in history, in my life. This is my truth. I cannot change that truth. And that's why I am working hard to also share that truth with you here. And for some, it will work. For those who will believe it will work. For those who don't, there are index funds, not bad. You invest in the S&P 500. The key is that when it crashes 50%, you buy more, and you will end up okay. Actually, a little bit better than average because you will be buying when it's cheap that everyone is selling. That's the key. You will do okay, maybe not as good as real investing will do because you are now paying a 30 P ratio, but you will do okay. But I'm not happy with okay in life because the markets did really well, but maybe in the next 10-20 years will do really, really bad. I want to do good also in that, and I'm prepared to work for it. This is from Warren Buffett's 1985 letter to shareholders, and there he thanks the totally efficient market hypothesis that is index funds and all the theory related to it. Just put your money in that, don't think. And he says that We are enormously indebted to those academics. What could be more advantageous in an intellectual contest, whether it's bridge, chess, or stock selection, than to have opponents who have been taught that thinking is a waste of energy. Thinking is a waste of energy. And in that line, there is this question. There has been a massive opportunity cost over the last 15 years for Buffett carrying excessive amounts of cash. It's easy to say in hindsight, and again, it seems mathematically impossible to outperform the S&P 500 over the next 3 to 5 years with that much cash. And I say, investing is about risk first, at least value investing, not outperforming. That's the difference between Buffett and the rest got slaughtered here. Buffett made 10x. The rest got slaughtered here, 2009. Buffett was saving banks and buying Burlington Northern and others. So that is Warren Buffett managing risk first. It was impossible to know that we would enjoy the greatest bull market in history of all time. That is why investing is risk and reward. And then when the question comes, Sven, what would it take for you to admit the Boglehead strategy advocated by both Jack Bogle and Warren Buffett? It's not advocated by Buffett. Buffett says it's better for most people. Back to the average thing. Is superior to what you advocate as a strategy philosophy. My story tells me it isn't. My story tells me yes, the S&P 500 can go up 30% per year, but the dividend yield is 1.3%. That's Boglehead will be used in a negative environment if this reverts to 5% as it was historically normal. I want to invest so that no matter what happens with the market, no matter what happens with interest rates, no matter what, I am rewarded as an investor. Bogleheadism, index funds started in the 1970s, were invented in the 1970s, didn't exist before that. And since the 1980s, there was this boom because interest rates went from 20 to 0. Because in the last 5 years, the Fed printed piles of money to save Bogleheads behinds. That's the truth. Let me see over a few cycles, that's 40, 80 years, we'll be here to check that on this YouTube channel. Subscribe for that if you want to do value investing. If you're a Boglehead, what are you watching here? See you in the next video.